Hello and welcome to the Movers and Shakers podcast. My name is Gino Barbaro, co-founder of Jake and Gino, multifamily investor, educator, father, and mentor. Today's guests are Bobby, Matus, and John Allen. Together, they make up Blue 22 Capital. After living abroad for several years as directors of complex international development projects, they felt the draw to return to the United States and apply their skills to multifamily. They joined our community in March of 2021, and in their own words, it has accelerated their launch through knowledge, networking, mentoring, and partnering. Welcome to the show, Bobby and John. Guys, how you doing?
Fantastic.
Thanks, Gino. It's great to be here.
Haven't seen you in a little while. I caught up with you before the show, and the great thing I love about what both of you said was it's been a journey for you. I mean, through multifamily. I joking around. I know, John, you were Bobby's boss for a little bit. That might have been a little bit tough, working with him.
3 months. After 3 months, enough was enough. Right?
and I could say Bobby's the chattery one, right? Bobby likes to talk. Bobby's the investor relations guy.
I'm trying to come out of my shell,
And John is more the spreadsheet guy. But I really want to dive into the show because what you said to me was really, to me, what propelled me to get into multifamily, the partnership aspect of it. Bobby, how did you know that guy next to you was the partner for you? And John, how did you know Bobby was the right guy for you? Bobby, go into that thought process that you guys sat down and said, this is what we need for multifamily. This is what you're good at. This is what I'm good at. Let's dive into that.
We come from more of that problem analytical background from management, from MBAs, etc. And we knew that we wanted to do this. And we got together. We flew up. John was in Brazil at the time. I was in Washington, D.C., taking care of some elderly folks in the family. And then we got together and we did a 2x2. We did it. We wrote out the 11 things that are important to be successful in multifamily. And then we did an exercise together. We have pictures of us, the whiteboard, the flip charts on the wall, etc. But it's a 2x2. What are you good at? What are you not good at? What do you love to do? What do you not like to do? And we found, very complementary, and we put our dots there, and we found a very complementary pattern. There was one element, I forgot which element, what it was, that both of us didn't like to do. I think it was and that really showed us that we were a complementary partnership. But in addition, the 12 years of knowing each other and the values and the admiration you have for one another for your strengths. John's super disciplined. Get up at 4:30 in the morning. His routines and his patterns are just super great. And he admires me when I can walk into any town and just pick up a conversation with either the head of the Chamber of Commerce or the cleaning lady, and have that extroverted conversation.
Mm-hmm. Yeah, I think it comes down to self-awareness, knowing what you're good at, what you're not good at, coming to terms with that, and then trying to find the complementary skills. So it's shared values, but complementary skills, complementary strengths. And Bobby takes on a lot of the capital raising, does a lot of the asset management. I focus more on the deal finding, sourcing, doing a lot of the analytics, doing the lending. And so just understanding what you're good at and where you need to lean on somebody.
On that 2x2 grid, on that not good at a lot of things, that box would be filled up. I'd have a lot of that filled up for not good at. I suck at a lot of things. So it become very apparent to me. But, Bobby, let's dive into some of the tasks, because we had Closers Club 7 last night. We had the webinar with 2 of our students, and the recurring theme was multifamily is a team sport. Team sport. You can't do it all by yourself. What are some of the things that you can think of off the top of your head that you really need to be really good at in multifamily? You just mentioned, John, you mentioned capital raising, and you mentioned asset management. Those are 2 keys, John. I just took down notes. What else do you think, Bobby, if you can expand upon, that you need to be good in multifamily? And if you're not good at it, find somebody who is.
That's a huge thing, which is finding folks. I think running the gamut, from, for us, for me, a large part has been like our networking. Within that network is, who are your investors, your capital raisers, and then your direct investor base. Then there's your broker relationships, and then there's your, to find deal flow, and or direct to landlords, and then it's kind of the team. And the team, runs the gamut to execute. So that networking piece, from contractors to property managers to syndication attorneys to legal attorneys. So really building out that network is a big thing. Once you have all that, what I'm finding, I'm almost thinking of my list is just like, hey, we need systems, you know, like building those systems and how do you build it and manage all that information. So how do you get systematic about things? So managing that element. And then also, you know, there's a wealth of the tasks in managing in underwriting, being able to underwrite and then also to structure the deal.
I'm sorry, I'm just taking notes down because I want to repeat a lot of this stuff because it's really, really important. Underwrite, structuring deals. So you've got networking, everybody. You've got investor relationships. You've got broker relationships. You've got deal flow. You've got building a team. You've got capital raising. You've got asset management. You've got underwriting. You've got structuring the deal. There's a lot of different tasks that are going on. That's why partnerships are great in multifamily. That's why joining a community like Jake and Gino really helps you out, because if you can't do it all yourself, when you first start out, you're probably going to end up doing the vast majority of it. But as you start to grow and expand, you start picking and choosing, you know, what I think you're really good at. John, I just should have started out with your story from the very beginning because I was very impressed. You're overseas. Most people start out and go, oh, well, I can't invest. You're not even in this country and you're starting to invest in real estate and you're starting to do what we call the BRRRR strategy. You didn't know what the BRRRR strategy was 10 years ago, but you were doing it from overseas. But then what was the epiphany that you're like, I can't do this fast enough? You built a nice little nest egg, but you say to yourself, one at a time, this doesn't make sense. Can you share how you started out in real estate overseas?
Yeah, I mean, it's just a matter of, you know, having saved up a little bit of capital and trying to figure out what to do with that. And then being overseas and not wanting to invest overseas, but wanting to invest back in the US. What did I know? I knew where I grew up. I knew my town, I knew the market. And so it's just a matter of connecting in with local brokers and then just trying to find that first deal, investing in that first deal. You know, same thing what Bobby said about building a good team. So I had a good contractor in place, I had a good broker that was finding the deals for me. And you know, once you build that team and have the contractor, have the property manager, have the broker, and once you go through one or two cycles of that and you're able to pull your cash back out, redeploy it, and then just use that original capital outlay from your first deal, and then just keep rinsing and repeating and building that up, it gets to the point where you build up a nice portfolio. But with that, right, with you know, say with 8 doors and 8 properties, there's still, you know, you're still filing taxes and having to do a lot of the accounting on each of the properties. You know, you lose one tenant on one property, then it knocks down your vacancy quite a bit. And so, you know, one is just the amount of time and effort that it takes to manage individual single family properties, and then realizing that if you really want to build scale, it's much easier to do that by, you know, by syndicating, by bringing in additional capital, by leveraging that capital to acquire larger properties, building out bigger teams, and then really taking that to scale.
And how is that conversation when you realize multifamily is the right thing? And how did you approach Bobby? And how did that go? Where you guys are like, okay, we need to do multifamily. And how did you convince Bobby? Because Bobby's probably like, you're crazy. I don't know what you're talking. This multifamily thing. I got to see that conversation in the beginning. He's like, I don't know what you're talking about here. I see you got a few houses here. What was that like? That conversation?
Yeah, well, I mean, we had planted the seed earlier on, so we had both worked overseas together in Nicaragua. We over rum and cigars, we sat down. I told him a bit about what I was doing with single family, the idea of trying to build out real estate in terms of generating long-term wealth, you know, for my family, for my children, and so we started that conversation early on, and then it's really just. What I recognize is that you know, when you're doing single family and you're using your own capital, it's one thing. If you're looking to scale and do multifamily, you need to bring in additional capital. You need to build teams. That's something that I'm much more focused more on the strategy, on the underwriting, on the financing, recognizing that, you know, in order really to syndicate and to be able to build build up that equity through larger deals, having to bring somebody on that's good with doing the asset management, that can, you know, be speaking, can talk to the property manager, can be out on site, can really run and do the asset management part of it. And then it's also just building out that investor base and building out the network. And you can tell Bobby's pretty good at he's good at shaking hands and kissing babies. So,
I was shaking babies and kissing hands for a while, but
So let me ask you, Bobby, were you all on board right away, or did you say to yourself, may seem daunting. This seems like a lot here. I mean, you've done a couple of homes, but buying a building with 10 or 12 units. How was that when he was presenting it to you, when he was pitching you?
It was an easy sale on a couple fronts. One is kind of just the entrepreneurial nature, even though I've worked, kind of, done that corporate route. But I think our field work, a decade, you're overseas and you're managing multi-million-dollar projects, but you're effectively running the show overseas. So you're rolling up the sleeves and helping farmers in Indonesia or working on, the sustainable tourism in Nicaragua. So that entrepreneurial nature, also some time in Silicon Valley as well, had me itching. I'd been at headquarters for a while, and I was itching to roll up my sleeves and take something from X to Y and deliver Z. So that's one piece of it. And second piece is in terms of leadership that you follow, when you see the credibility of John and how he took that and did that single family investing from overseas, from overseas, executing it and repeating it 8 times. It was something that and just knowing him and the projects that he's delivered, it's, I'd follow him anywhere in the sense of the thought leadership that he has. So it was a really easy sell. I wanted to do something, and 2, the person that you trust, have aligned values, has credibility and intellectual leadership, and then the opportunity. He called me up and said, "Hey, we're not moving back to DC. We're moving to North Carolina." And I said, "Hey, my headquarters is in North Carolina. We can do this." And he's like, "Why North Carolina?" Population growth, economic drive, the economic drivers. And we voted with our feet to move down here. We saw that this is a booming town and a super quality town. We can talk a little bit more about the economic corridors and the Toyota's moving down, the Vietnamese battery companies moving down. Jocko's I just heard last night or the other day, it has a factory for jeans in Asheboro.
Right.
So it's a booming place. So yeah, those 3 things made it really easy to pull the trigger and make the move.
Wow. You guys decide to get together. You're going to do it. What are the problems you experience as you start out multifamily? Because it's a whole new venture. It's not single family homes. All of a sudden, there's different metrics. There's different underwriting. What problems did you experience as soon as you started investing in multifamily? John and then Bobby.
Yeah, I think for us starting out, one is just, recognizing that it's all about relationships. And so getting out there and building those relationships, knocking on the doors of the brokers, trying to really build the compatibility in terms of communicating what we're doing, the investment that we made in terms of moving the families down to North Carolina, talking about the transitioning from single family to multifamily, talking about having already invested as LPs in multifamily deals, showing how we understand the market, assessing the market, and really building that the credibility with the brokers to get those first deals, to see those first deals. That I think was a challenge, just because it was something that was new to us and something that where it's not a matter of just picking something off the MLS like it is in single family, but really going out and building that deal funnel. So I think that was a challenge for us. And then just with the syndication and understanding how to build out that network and how to really develop the deep bench of potential partners and investors was something for us, which we didn't have experience doing that in single family. And so really moving that from that jump from single family to multifamily was really those challenges and the big differences between the move from single to multi were I think those were the ones that stuck out for us.
Yeah. That's awesome. And for you, Bobby?
You know what, it's been October 1st will be a 2-year journey when we did the 2x2. But for me, it was really saying, hey, that need for is me and John for 6 months from October to March of really being like, hey, yeah, this is what we're gonna do. Let's do a business plan. Here we have Asada, and so but it was the John and Bobby show. So it was really like I felt like keeping motivated within that microcosm. It was like getting out there. So to John's point, getting out there and tapping a network that you give and you get energy from. And I think that was a big thing, and learning from. And then the second thing was we wanted to be wise guys, not smart guys. So I'm talking about this at Christmas And people are like, hey, count me in for 50, count me in for 25. And these are the people that you love and their savings. And I'm like, man, this is getting real. So it was about that credibility in a program, really having that, and which we decided in March of 21, they're like, hey, we're doing this, and this is real money and real people. So let's not, smart people learn from their own errors. Let's be wise people that learn from the errors of others. So and that's when we looked at about 7 different programs, and we settled on Jake and Gino in April of 21. And that afforded us the structured education program, the coaching, which was like Bill Ham's our coach, and it was like who wants to be a millionaire in a lifeline? He was like, hey man, can you look at this deal? Are we crazy or what? So it's really great. And then the network and the events that just brought energy and inspiration, etc. So I think those 2 things were the things we're missing, kind of the need for network and then the program and credibility.
Can you both speak to the fact that you were economic deserters of the Northeast? Because I could speak about it for the next 6 years, because that was like one of the best decisions I ever made. Marrying my wife, having kids, starting Jake and Gino, multifamily, and leaving New York. And not because I didn't love New York. It was just the weather. It was just the taxes. I went to Florida. How was it for your families? I mean, was it a hard sell, Bobby, for you to move out of DC to go to North Carolina? And how is that now that you've done that?
Well, the next podcast, we'll bring my wife, and she'll tell you. She's like, I hate DC. I mean, DC is where I grew up. I love it, but part of the thing of being overseas is that your community gets small, and you're a bigger fish in a smaller pond, if you will. But Raleigh, the Raleigh metropolitan area is cosmopolitan enough that you can get a fancy meal and great sushi and Thai, etc. But you can park in front of where you want to go on a Saturday night at 6 o'clock.
Yes.
So that's what we loved when we were in Jordan and Nicaragua, etc., because it's community. And it didn't hurt that you could buy double the house for half the money. And so that made our family an easy sell.
That's the title of the podcast: Double the House for Half the Money. I love that. And as another quote from Wyatt Simon from last night: invest in the S and me, not the S&P. That's what you guys did. So, I mean, talking to Jake and Gino students, I just get smarter every day. All I got to do is keep doing podcasts with the Jake and Gino community. I get a lot smarter. So, double the house, half. I like double. Say it again.
Well, the past couple of years, it's like a third of 2/3.
Well, it has to, because there's so many people moving down, and but that's okay. You did it. You took a big risk. You said to yourself, this is what my future is. And obviously everybody wants to get into multifamily. If you want to make your backyard, find a great place that you want to live. And maybe that's where you become your backyard. And for you, John, you had lived overseas for years. Did you come back and go to North Carolina right away, or what did you end up doing?
Yeah, we did. So we had the luxury of being able to choose. I think one of the few silver linings of COVID was that, coming back to a U.S. based position, we were able to choose where we wanted to come back. And so, for us, we wanted to stay East Coast. We wanted to be close to my family who's still up in Philadelphia. But I was really thinking about the real estate and sort of the next 5 years out, and did a lot of market analysis and looking at different places, looking at Florida, looking at Texas, looking at North Carolina, and then just was just looking at different economic and employment drivers, and looking at the quality of life, and looking at the quality of education, and just kept coming back to North Carolina, to Charlotte, and to Raleigh. Charlotte was probably a little too big for us, and so then settled on Raleigh, and it's been a great experience.
I love that. You guys start looking at deals. Everyone thinks it's easy, but Bobby, talk about the first deal. I mean, you're looking at 100 deals. You just talked about that 130, the LOIs and the accepted offers. How was that, looking at those first 100 deals to get that first deal under contract?
We'll put the time machine on and back reverse into that, this time, July to December of last year. And it was a frothy market, right? So we were, and we were dry, meeting brokers, going to check out, keep the tires on properties, getting to primary, secondary, tertiary. And we're like, wow, this is in the sticks. We look at we kissed a lot of frogs in that, looking at 100 properties. Mm-hmm. But that experience helped us kind of find the edges and helped us refine our criteria of what we're looking for. You know, we're just like, this doesn't have the employment driver. This has, you know, this is from the 50s and has an elevator, you know, like this is in the basement. And also size wise. So it really looking at 100, getting out there, getting in the car. And, you know, we would take days off from work and do, you know, most recently we did like a 15-hour tour of different properties, meeting brokers, meeting other Jake and Gino students. And that for me, when, you know, is the enriching experience, kicking the tires, seeing the properties, and meeting the brokers and other investors.
That's awesome. And for you, John?
Yeah, I mean, it's you know, for this first deal, a lot of it was building those relationships with local brokers, and then, you know, making sure, I mean, ensuring that we can communicate. We had our buy right or criteria, and so once we were clear on our buy right criteria, we could communicate that buy right criteria to the brokers. And, you know, starting off small, letting them know this is the type of property we're looking for, this is the type of submarket we're looking for. And then by keeping in touch with those brokers, finding, you know, a broker sees a deal down in Fayetteville, has an owner that's been managing it since 1980. I was looking to get out, was looking for something simple, clear, clean transaction. The broker had our buy right criteria. They knew us, they trusted us, and they came to us and said, listen, there's this property. You guys, you know, do the analysis, put the price on it, and if it works out, then let's move it forward.
Wow. So putting in the work, number one, kissing a lot of frogs, number two. But what that also did for the both of you is you really got to understand the market. You became an expert in that market, and you became an expert, and you created what we call the buy right criteria, which is important because you're able to focus. You're able to say, as entrepreneurs, you have so many opportunities coming to you. If you're able to say no to an opportunity real quick, that means you can get to yes to another opportunity. And that's what I think people have to focus on. And this is a conversation that I have with a lot of beginning students and people getting into multifamily. Their first question is, I need a deal. I need deal flow. And I say, hold on, time out. Before you get deal flow and you need a deal, what's a deal for you? Because for Bobby and for John, it's different than what it is for Jake and for Gino and for Mary and for Jim. You have to understand what your buyer criteria is, what you're willing to do. Are you going to start syndicating deals? Are you going to start JVing deals? Or are you going to start doing creative financing? It all depends upon what your criteria is. And it sounds like you guys really nailed it down. Now, the first deal, do you want to jump into the first deal real quick with the numbers? Because I'd love to share it with the community as well.
Outstanding. Yeah. So that process of finding that this was a small asset. It was an 8-unit townhouse style. 87-year-old gentleman who was getting out of the business, hadn't raised some of the rents. You know, average rents were $518 for a 2-bedroom, 900, 2, 1.5, and 900 square feet. Had a laundry room on the side. It's about 200 square feet, and so, but in an area of Fayetteville that was right by this retail corridor. Right, it's good bones on the place. Going to take a look at it, so that came out to like 63 a door or so, 60 to, and we saw a vision there of really upgrading this to solid workforce housing, to really have the black appliances, LVP floors, and bringing to market rent. You know, we through the network, we found a property manager. He's like 800 all day, if not more. You know, like let's do that. And so we got into that. And so, you know, John can tell you a little bit about the financing and kind of the execution of that deal. But our vision for that was to upgrade the units, and put washer dryer hookups in there in order to free up the laundry room and turn that into a studio.
What year vintage is it? What year is it? What year is the property?
1972.
So it's a 72 build. I like townhomes. I like 2 beds. I like washer dryer hookups. There's a lot of things that I like. And if you talk about the corridor and the path of progress, that's another thing that I really love about the deal. And it's a great deal. You guys can control it, take care of it yourselves. You can work on it. No deal is better than a bad deal. So this sounds like a really good deal. It's mid-60s a door, $800 in rents. John, how did you finance this thing?
We did it through a community bank. So we
All right.
found a brokerage, a loan brokerage that operates out of Fayetteville, knows all the local banks, and established that relationship, and then looked at a number of different opportunities and settled on a community bank that was able to give us a good loan to cost. So for us, we really wanted to try to leverage to the extent possible our cost of capital to keep that low. So we got a loan to cost of around 78%. And then this was, it was a 4.5% rate. It was a floating rate, but it had a cap at 5.2%. And, it was good 7-year term for us. We wanted to lock in long-term. We started, it's obviously much more present now, but even towards the beginning of the year, we're starting to see the market change, and we were really careful about not wanting to get into bridge debt and having to be out of this in a year and a half, 2 years. And so we wanted to lock in long-term debt. So we have a 7-year term, 1-year IO. It's going to be a pretty quick turnaround on the rehab. And it just made good sense for us.
What is the exit strategy? You guys going to hold this deal? You're going to sell the deal? What does it look like for you?
Yeah, we're going to hold it. The strategy is to hold it 5 years. And so we want to be able to get some really good cash flow out of it, which is important for us. And so, we'll see. We'll keep it. We have pretty favorable prepayment penalties on this, and so if we wanted to get out earlier, we could. But the game plan is to hold on to this for 5 years, see where it's at. Leverage that cash flow after years, 2, 3, 4, and 5, and then we'll look to sell it and then return capital.
You never know. After 5 years, you may like the property. If the property's been in rehab, you've got flooring for 20 years, you've got new appliances, you've done work on the property. You may say to yourself, hey, this is not a bad deal. I've got some cost segregation going on. I like it. Now, what ends up happening is you may see after 5 years, you're going after a 100-unit property. I've got capital in this 8-unit. I've got a lot of equity. You're going to sell this property and roll it into the larger unit. So having that flexibility allows you to be able to do that. Bobby, can you answer this question? And I want John to answer it as well. What does, I guess, the future look like for you now that you're in multifamily and you have the possibility and maybe the dream of one day becoming a multifamily entrepreneur full time?
Yeah, it is. So one just additional note on that. So we raised $250,000. We did that initial one thinking about the future. So we went through the vendors of Jake and Gino, got Kim from syndication attorneys to do a full syndication. $250,000 is not that much money, but we wanted to do it with a vision for scale. So we did that, best in class real estate lawyer, et cetera. So that really kind of got us some internal credibility, et cetera. And that relates to your question, where we've been, we got our sea legs. Where we are right now, we're building a platform and a network. And in addition, we're under contract for a 30-unit right now that's planning to close in the first week of October. Yeah. So pretty excited. We got a raise that we're working with about 3/4 of the way there, but just kind of finishing that up. And that's one of the things, that I'm working on. But that's kind of where we are. We're building our systems. We want our vision is to eventually do this full time. And that is our mark, and really dedicate ourselves to real estate. This is we see the value in that we bring to the communities of tenants, the community of investors, and the community of the real estate professionals that are making deals work. And we see that people see us as credible folks in the business. So we're getting that repeat business.
I love it. And John,
where are we going? Looking to end the deal. That's with this deal will be at 38 units, but are really looking at eventually getting into $10 million assets under management, and then growing that to an eventual point in the 20 to 30 range where we can both leave and focus on this full time. And
for you, John?
Yeah, I mean, I think it's pretty similar, and it's this idea, it's the idea of the conveyor belt, right? We're starting out, year one, we got 1 property. Year 2, we're going to hopefully close on 2 properties, and then building out that conveyor belt, getting 5 years down the line, building out that equity, and then having that equity and be able to decide whether or not we want to continue to roll that equity into larger deals and continue to build up that equity stack and continue to grow and scale, or whether or not pull some of that equity out, invest that into passive income, start generating additional cash flow. It's the idea of having the optionality, which is great. And so, what we're looking for is, if this, Blue 22 is going great, let's keep it going, fantastic. but also thinking from in terms of just having that optionality from a personal life perspective, right? Spend more time with the family, be able to travel. It's having the freedom of time, the freedom of money. And so that's really, how do we put these systems in? How do we scale this up? And then for us too, we spent the last 20 years building communities overseas through social and economic development projects. What we're doing with multifamily here in North Carolina is building community, but building community in our multifamily assets and supporting workforce housing. So that's something that's just it's part of who we are. It's in our DNA. Whether we're doing international development and helping communities overseas or doing it here locally, really our focus is with multifamily commercial real estate is how can we improve the communities for those that are in our assets and that especially workforce housing families that are looking for a very dignified and proper place to live.
Before I have you guys share your contact information, I have to recap the show with the story, but I also have to go through a lot of these different golden nuggets that you guys provided. The conversation starts, basically, Bobby, John, you've done 8 flips, 8 birds. You sit around, you're smoking a cigar together, the both of you, and you decide, this multifamily thing sounds like a good opportunity. I'm doing these one-offs. How do I start scaling up? And then you guys decide, well, we need to invest in ourselves. That's the important thing. Investing in ourselves, because multifamily is a little bit different than single family. It doesn't take a rocket scientist. If pizza guy and a drug rep can do it, anybody can do it. It's just a matter of understanding, the little differences, understanding that it is a team sport. Now, there's a lot of things that I took away from the show. The partnership aspect, everybody, go back and listen to that, because that's truly important. When you're doing it with somebody else, it's great. Jake's not on the podcast right now. Jake's doing something else. When you have someone else helping you, when you're not maybe a great capital raiser, but you're great at underwriting, gravitate towards what you're really good at and have a partner help you out, because 1 + 1 is not 2. 1 + 1 can mean multiple things. And to me, it's very admirable that you guys bought an 8-unit. Most people are going to say to themselves, oh, 8 units too small. It's not the idea. It's just a start. We started with a 25-unit property. I actually started with a 4-plex years and years ago, but it gets you in the game. And like you said, oh, it's only a $250,000 raise. Well, only $250,000 raise. If you've never done that before, that's a raise. You've gone through the process now. Now that $250,000 raise becomes a $600,000 raise, which becomes $1 million raise. We all have in our minds the ability to say, I want to jump into a $5 million raise on my first deal. Well, you know what? Behaviors are belief driven. If you think you can do it, great. But if you think you can't raise $5 million in your first deal, but you can raise 250, go back and do the smaller deal. Get that credibility like Bobby and John are talking about. That's really, really important. Scaling up, taking the time, learning, networking. It's all in the show right now. Go back and listen to it. Really impressive story. I love the story. And if somebody can do it from overseas, there's no excuse for somebody who's living in the States right now who has access. So where can listeners get a hold of you guys?
So website's www.blue22capital.com, and it's John at blue22capital.com, Bobby at blue22capital.com. Email's probably the best way. And then I'll give out my number for folks that want to just reach out to me. My number is 202-320-4328. That's 202-320-4328, or HEAT is what it actually spells.
It's funny. It was one. I didn't think John was going to give his number out. I had a feeling Bobby was going to throw the number out. I'm just saying, right? I'm going to leave John the last word. John, last word from you, brother. Let me hear it.
No. I mean, it's been a wonderful experience, Gino, being part of this community. I know Bobby's heading out this week to Knoxville. It's been having the support of you guys, Bill. It's really about building community, whether it's with our multifamily assets, whether it's with the community within Jake and Gino. It's been uplifting over this last year to count on so much support and goodwill. We're bullish on North Carolina. It's a great market, and we're excited to reach out and to connect with people, folks that are interested in North Carolina. Yeah. We're here. We're boots on the ground, and we're happy to have that conversation.
That's awesome. And for everybody out there, I'm getting on a plane today. I'm flying to Knoxville for the Money Mixer this weekend. There are going to be people on a bus, the Jake and Gino community. Bob, you're going to be walking our assets. You're going to have, you're able to speak to our asset managers, our property managers. Make sure you get Jen Outland. You grab her, say, hey, Jen, I got some systems going on, property docs, weekly pulses. That's where you're getting to right now. And it's exciting. It's scary, but it's exciting at the same time. And that growth is awesome. It's all about the growth mindset. I want to thank you both for coming on the show and sharing your story, getting a little vulnerable with us, talk about cigars, your first deal, moving out of DC and all that. So, if you like the show, everybody, please leave us a review. Until next time, let's all make it a Movers and Shakers week. Thanks, fellas.